Steingraber here, doing a video to preview what's coming at NJRASN next Wednesday, February 12th, 2020, at 6 to 10 p.m. at the Westwood in Garwood, New Jersey. So if you're in Jersey, come on out. If you're not, just enjoy this training and you'll get a lot out of it, especially if you're either new to real estate or you've been in real estate for a long time, but you don't really raise private money. You do things the traditional way. So in this training, I'm basically going to teach you guys why investors and how investors borrow private money, meaning that they don't go the traditional route with banking. So I'm going to compare traditional banking. I'm also going to talk about hard money loans. And if you're interested in real estate investing, our real estate club is a great place to come out. And if you're experienced, it's an awesome place to come out as well and network and get educated and have a full buffet dinner. So just for tuning in today, for those of you that are interested in coming out to the Raising Private Money training next Wednesday, and for watching this video, I'm going to give you guys a discount and a promo code for that. So typically it's $35. With the promo code, you'll get $15 off. So it's the promo code, all you have to do is go to njresn.com. So go to njresn.com. And I think you have to put the www actually. This isn't really working well, but you have to put the www.njresn.com. And then you have to use the promo code FB Live. Even though this is not live, I was going to go live on Facebook, but I couldn't figure out how to share my screen and I wanted to write on the screen. So anyway, let's get into the training. Go to njresn.com, promo code FB Live. So when you go to checkout, above the name of the ticket, there's enter promo code. So just click on that blue little link. It's small, so don't miss it. And then you can enter this in and you'll get $15 off. So that's for the first 20 people for that. Okay, so let's start out by talking about what's the traditional bank way, right? So when people borrow money, typically they're borrowing money from a bank, and that bank is lending them money on what? Typically an investment property or your primary residence. So let's talk about your primary residence for a second, right? And just so everybody understands, I'm going to basically define what private money is with this example, right? So let's talk about the traditional way. So let's say somebody's looking to buy a house for $300,000, right? And this is a family, first-time home buyers. They have the option of putting 3.5% down, right? If the property qualifies for what's called an FHA loan, they can actually do the 97 program, which is only 3% down, and that's a conventional program. They could put 5% down, they could put 10% down, 20%, etc. Right? So let's say it's just a first-time home buyer. The bank will actually lend this first-time home buyer, somebody that's never purchased a house in their entire life, right? They're a first-time home buyer. Obviously, they're going to check their credit score, right? So they're going to qualify them based on credit, income, and then what's called DTI, which is debt to income. They want to make sure that they can afford the monthly payment and, no more than, let's say, 40 or 50% of the income that they have after deducting, some, fixed monthly expenses. They have to have they can only allocate about 50% of their income towards their PITI payment, which is principal, interest, taxes, and insurance. So you need to qualify personally to get this type of loan. We're going to talk about how it works with private money in a little bit. So you borrow almost $300,000, right? So 96.5% the bank will give you, right? So if a property is worth $300,000, right, that's what you're buying it for. That's the purchase price. And the value, right, it has to appraise. The value is also $300,000. The bank will give you 96.5%. That's called loan to value. They'll give you a loan for 96.5% if you get the 3.5% FHA loan. And of course, you're going to pay primary mortgage insurance or PMI. or MIP. Different people call it different things. And that's going to cost you some money just in case you default. It protects them in the case of a default, right? Some other programs don't have that. So the loan to value is 96.5% to a person that's never purchased a home before. Now, if the market goes down 5%, right, they're already what's called underwater, right? Meaning they owe more on their house than what it's actually worth, right? So the reason I'm talking about this is because it is so normal to us to say, when I want to buy a house, I'm going to go to the bank, right? And I'm going to get a loan. But when we start talking about borrowing private money, and private money is exactly what it sounds like. It's borrowing money from a private individual, right? Sometimes from a private institution. Some private institutions call themselves private money lenders. So you're borrowing money not from a bank, but you're borrowing money from a person. And a lot of people can't wrap their head around being able to do real estate flips where you buy a house, you fix it up, and you sell it in, let's say, 4 to 8 months, somewhere, anything, below 12 months, sooner than 12 months. They can't wrap their head around, well, why would somebody lend me, $200,000 to buy a house and then also give me the renovation money for another $100,000? So how can I 100% finance this transaction? And I'm going to show you why they will. Okay, but first you have to understand the context here. This is what we're used to doing. We're trained and programmed to go to the bank and they'll give us a lot of money, right? The majority of the money, 97%, 96.5%, 95% if you put 5% down, that's a lot. So are they taking a risk? Yes, right? They're taking a risk on you, and that's why they look at this. But if you lose their job, do they have control over that? No. So you can't make your monthly payment. Most people live paycheck to what? Paycheck, right? So it's really interesting how people's mindset around getting a bank loan is, I can easily get a bank loan, or I can, that's the normal way and it makes total sense to do it. But when you start saying, hey, why don't you just buy a house, fix it up and sell it with other people's money? People go, who's going to lend me any money? Nobody's ever going to lend you 100% financing. Okay, so I kind of rallied on that for a little bit. So now let's talk about private money lending, right? So let's say, and this is kind of like a typical type of transaction, you would buy a house for $200,000, right? A house that needs a lot of work, right? So this is the purchase price. And then the renovation would cost you about $100,000. This is the reno, right? So you're into it for about $300,000. It's a little more because you have closing costs, but let's just say that this is the capital that you need to be able to do this transaction. Okay, now, obviously the resale value, right? The resale value has to be around $400,000 in order for this deal to make sense to do. Why? Because you have a bunch of expenses here, and I'm not going to go into that right now, but you have a lot of expenses. You have about $50,000 in financing costs, taxes, closing costs when you sell the property, insurance, utilities, due diligence costs, and then, everything else that comes with owning a property, right? Maintenance, landscaping, snow removal if you own the property during the winter, right? So this is a good deal, right? If you buy a house for $200,000, it's in disrepair, right? You put $100,000 in renovation into it, and you're going to sell it for $400,000. You'll probably make about a $50,000 profit, okay? Because you're going to have another $50,000 in expenses. So your total expenses are going to be about $350,000, right? So anyway, now why would somebody lend us the $300,000? Why would somebody lend us the $300,000? Well, if the after repair value is $400,000, the resale value, right, or ARV, then we are only borrowing about 75%, right, of the resale value. Meaning, if you do your job and you put this $100,000 in renovations into this property, then this is a lower risk transaction, okay, than let's say the 96.5% LTV. right? Because the loan to resale value here is 75%. So it's very normal to be able to borrow $200,000 to buy the property, okay, 100% financed, right? And then for the lender to also give you $100,000, or another lender to give you a second loan, right, on the property for $100,000. And this isn't always given up front. This sometimes is given in waves. So they say, okay, I'll give you $20,000 and I want to see that you did some work. Then I'll give you another $20,000 all the way until you've completed the job. So when you're done with the property, right, we got an after repair value appraisal, and let's say it came in at 400. So then your total debt's going to be $300,000 plus maybe some interest, right? And you're going to owe the lender $300,000 plus some interest, and basically the house is worth 400. So if you don't pay the lender when you said you were going to pay them, they get to foreclose on you and get a $400,000 asset. So it's collateralized by an asset that has about $100,000 in equity, okay? If you do what you're supposed to do, right? If you're not doing what you're supposed to do, they're not going to keep releasing this, these renovation payments. Excuse me. So when you buy a house, let's say for $200,000, and finding these deals is another story, right? That's a whole nother training, and we do those trainings. So let's assume that you did the marketing, to get a motivated seller lead. Like I just put up 6 billboards, for people to sell their house today and call this number, right? So different training. You buy the house for 200, you renovate it for 100, you sell it for 400. Now, what we're in need of is this. We're in need of the $300,000. Now, the loan to value is only 75%, right? That's good. That's actually better than the traditional banks, okay? Now, the good thing about borrowing private money from private individuals is a couple things. You can negotiate the terms, okay? What does that mean? That you can negotiate the interest rate. And if you think about it, who has that opportunity? Who has the opportunity to just invest in an investment property and give a loan on it and make a good rate of return? Not too many people are aware that this is even possible. Like you can do this with your 401k. If you have an old 401k with $100,000 into it, with $100,000 in it, you can lend out of that. That's called a self-directed retirement account. Okay, so normal people, just anybody, can lend a real estate investor money and make a good rate of return on their money, right? If they were to put that money in a CD or an annuity or a mutual fund or something like that, what are they going to get and what are the risks that they're taking in order to get that rate of return versus, let's say, something like this. And of course, I'm going to show you on Wednesday, February 12th. I think it's February 12th. Yes, February 12th, which is this Wednesday coming up. Exactly how to present and approach private money lenders. Okay, we're going to talk about all that. This is kind of like a preview training for you to understand, why private money lending should be part of your arsenal. Okay, so let's now compare stuff. So let's say, we're going to compare private money loans to a bank, right? Because if you have good credit, good income, you could go to a bank, right? And there's nothing wrong with going to a bank, by the way, right? But let's say we wanted to do that same deal, right? Here, the purchase price is $200,000, renovation is $100,000. We're looking for $300,000 investment, right? Well, the bank, that's not how the bank's going to operate. The bank is going to say, okay, the purchase price is $200,000. Your reno is $100,000. So, the total amount is $300,000. So how much skin in the game are you going to put, right? And they're typically going to require 20 to 30% down. Now, if you do a Fannie Mae home style, you can get away with about 15%, okay, down. But you're going to need some reserves most likely. And let's just use a 20% down number, okay? Just because it's also easier math, right? So they're going to say the total is 300, so we'll give you 240, right? As long as, it appraises for the number that we need it to appraise at for us to be at, let's say, a 70% or 75%, right? Loan to purchase, not loan to value. A lot of people get this wrong and they don't understand the difference. I'm going to talk about it, right? So let's say the $240,000 they're lending you, you're going to have to come up with $60,000, right? Then you're also going to have to come up with, let's say $20,000 to $25,000, right, of the renovation money up front, because they want to see the work done before they release funds. Meaning they typically don't release you $20,000 or $25,000 for you to get started on the job. They want you to put the money up, renovate, start demo or whatever it is that you're doing. And then when they see that you've paid contractors, they want to see invoices and, checks and things like that, then they'll release the $20,000, $25,000 to you. So, right. So then you'll get your money back. Then you have to use it again, right, for the next phase of construction. And you might have 3 or 4 phases, right, or maybe 5 with a $100,000 renovation. So you're going to need about $85,000 this way. Okay, now with that being said, we're borrowing $240,000. Assuming you have to borrow this $85,000, or even if you're using your own money, there has to be some sort of percentage that you charge yourself to use that money, right? So either way, you're paying interest on all of it, whether it's in the form of an opportunity cost, because you can't use that $85,000 to put it in a savings account, and you can't use it to put it on a down payment on a multifamily property, right? You can't use it. There's nothing you can use it for because it's tied up in this deal until you sell it. And then when you sell the property, you pay off the bank and then you get your money back, right? So either way, there's a cost to that money. And a lot of people don't put a cost to their own money, but you should, okay? Financially, you should. Okay, and we'll talk about the fees in a second. So that's the downside of this. There's also monthly payments. So with the banks, you have to make monthly payments, right? Obviously, you're going to have to get insurance, which you should get insurance over here as well. So that stays the same. But with private money lenders, we do not have to have monthly payments. Not saying that some professionals or institutional private money lenders or bigger private money lender companies don't require it, because some of them do. But if you're dealing with a regular individual, it's kind of like, if you invest in the stock market and you're investing in stocks that don't have a dividend, you're not going to get monthly payouts, right? When the stocks sell, right, that's when you get paid your money back plus any earnings that you had, or subtract any losses. In this case, if you borrow $300,000 at, let's say, 10% interest, right, that's $30,000 per year, right? So per day, it's probably like $80. So $300,000 times 0.10 is 10%. So that's $30,000 a year divided by 365 is $82.19, right? So that's your daily interest rate right here. Okay. Now, let's back up for a little bit. If we go the bank route, obviously you need to qualify, right? So assuming you can qualify, you have the credit, you have the debt to income ratio, it might go on your personal credit depending on what bank you're using. I went to a bank and they told me, and I bought the house in an LLC. I was told that it would not go on my personal credit because I closed on the property in an LLC and I got the mortgage in the LLC. Then they sold the loan to somebody else, right, after giving me the loan. And then that lender decided to report it to my credit. So I actually had the bank loan end up on my credit, which, it's not a horrible thing, but they told me it wasn't going to be on my personal credit because it wasn't a personal loan. It was a business loan. It was an LLC. So anyway, it could end up on your credit even if they tell you that it's not going to end up on your credit, right? And you're not going to fight it because there's no point in fighting it because you're going to flip the property in a few months. So anyway, here you have monthly payments. Now over here, if you negotiated no monthly payments, right? You get your money back, right? In 4 months, 6 months, whenever it is that I sell the property, you get that money back, but not to exceed a certain amount of time, like let's say 18 months, right? Because there's no way that you should hold that flip for more than 18 months if it's just a simple rehab, right? It's a $100,000 renovation, full renovation. You should be able to get it done in less than a year and a half, hopefully in 4 months to 6 months or less. So anyway, you have no monthly payments, right? And that's good, because if you're borrowing 100% of the money, now you just have to pay for taxes, right? Property taxes, insurance, utilities, right? Maintenance, right? So obviously there's still some money that is going to go out of your pocket, right? If taxes are in New Jersey, $9,000 a year, right? Insurance is $250 a month, right? So you're looking at $950 right there, and then utilities and loan maintenance, whatever, you're still probably looking at like $1,100 a month over here, right? On this house. Maybe it's a little less, maybe it's a little more, whatever, 1,000, 900, 1,100, 1,200. It depends on your price range, right? And the property taxes and all that stuff. Over here, you obviously still have that, right? Plus you have to make the mortgage payment. So over here, it might be $3,000 per month total, right? So this is your chokehold, right? This is a chokehold, because if you have three, properties going like this, and if you're in business as a flipper, you need to have 2, 3, 4 properties going at any given time, or else you're not going to make any money, right? You do 3 properties in 1 year and you make, $40,000, $50,000 per property. You're only making 150 grand. And then you have to subtract your marketing expenses and all your other expenses from that. So you're probably going to end up at like 120. Plus then you have to pay taxes on that. Federal, state, Social Security, Medicare, it's all flipped. So it's short-term income, short-term capital gains, ordinary income. So, if you pay 30% or 20%, well, with state, let's say 30% on the 120, right, there goes $36,000. So now you're only making, $80,000. It doesn't make sense, right? You have to make more than that if you're going to be taking the risks, right? I'm not saying 100,000 isn't a lot of money, and I'm not trying to insult anybody. I'm just saying it's not a lot of money for the risk that you're taking, right? Because you're borrowing all this money. So we have to have a few flips going at the same time, right? So if you have 3 or 4 flips going, now you're paying $3,000 a month on each one. That's going to limit you. So a lot of people, what are they going to do if they borrow money from the bank? They think that they're getting it at a discount, but the truth is it's limiting their business by a lot, right? Because they can only do one deal at a time now because of the terms, right? It's not always the interest rate that you're paying, right? Everybody focuses on, well, what interest rate are you going to give me, right? Well, it's not just that. It's like, well, what are the terms? Right? Here you need to make the monthly payments. So what are the terms, right? So let's say you have to pay 5% interest, right? Because it's an investment property loan. I know right now interest rates are all-time lows. I got it, but this is still an investment property loan, right? So in order for a bank to lend money on it, you have to understand, traditionally banks will make money on you over time, right? They'll make money on you for 5, 7, 8, 10 years. Right? Sometimes even longer, but most people either refinance or they sell their property after 7 or 10 years. This case, you're saying, I'm going to buy the house, I'm going to fix it up, and I'm going to sell it, and I'm going to do it as fast as I freaking can, right? Because I want to get out of this thing, because it's costing me money every single day to hold it, and I want to make the biggest amount of profit. So how does the bank look at that? The bank's like, wait a second, so you're going to be in and you're going to be out as fast as you possibly can. So we're talking about, 3 months, 6 months, right? And, there's no prepayment penalty, at least here in New Jersey. It's illegal on a residential property, right? So we're talking about residential properties, 1 to 4 unit homes. So if you're going to hold it for 3 to 6 months, and they're lending you $240,000 at 5%, right? What are we looking at here? 240,000, right? 240,000 times 0.05, right? That's what it is per year. So divide by 12 months. So per month, they're only making $1,000. So let's say you have it for 6 months. They're making $6,000, right? To lend you 240,000, right? The bank's not in the business of making a few $1,000. They want to make a lot more than that. right? And they're not going to be able to sell that loan for too much money because they're in and they're out, right? So anyway, I'm not a banker, so I don't really understand the exact numbers over there, but they're going to charge you more than just 5%. They're probably going to charge you about 1 point, right? Because 5% is not enough. And then they have fees, right? And not all the fees go to them, but they typically have a commitment fee for $500. Then there's an appraisal for another $500, right? And there could be some other fee, right? So let's just say that it's this, right? It's $1,000, right? And it could be more, but let's just say it's $1,000. 1 point of the 240, right, is $2,400. Plus, you're going to pay $1,000 in fees. So you're looking at $3,400, right? $3,400 plus the 5% over 6 months, right? So it's 34 plus the 6,000. So your total financing costs here, let me erase something over here so I can put it here. Your total financing costs over here are $9,400 if you get rid of this property. Financing costs, right? In 6 months. So it's $9,400, right? And they're not making a lot of money on that. So anyway, what is a private money lender? Well, let's say it's 10%, but there's no fees, right? They're not going to make you do this or make you do that. There's no application fee, things like that. So let's say you borrow $300,000, right? Now you're borrowing more, right? You're borrowing the whole amount. So you have to understand that too. So we're borrowing it at 10%, which is double the interest rate. We're going to divide that by 12, right? So we have $2,500 per month, right? Times 6. So it's $15,000. So you're paying $15,000 to finance it over here. If you borrowed the money at 8%, for example, 300,000 times 0.08 divided by 12 is $2,000 a month. So it would only be $12,000 at 8%. Now, this is more money, right, than this, obviously. But what about the $85,000 that you need to put up? What's your opportunity cost on that? If you didn't have it tied up here, what could you do with that money? So we have to put something on it, right? Let's say we could make at least 5% on the 85,000, right? 85,000 times 0.05 is 4,250. So it would actually cost you 4,250 plus 9,400. You're looking at 13,650, and that's only putting 5% ROI on this, assuming you can only make 5%, because you could put a down payment on a multifamily property and easily get 5% return on investment cash on cash. And then you also have depreciation that you get all the write-offs, right? The tenants are paying down your mortgage, but no, that money has to be put aside. If you're with the bank, you have to put that money aside, right? So just keep that in mind. And that does not include your monthly payments that you're shelling out, right? Because now over these 6 months, you're paying $18,000. Here, you're also paying some money, right? Let's say you're paying $12,600 here, right? Because you're going to have to make your monthly payments, 6 months would be $6,700, right? So you're shelling out some cash here, but it's nowhere near what you're putting out here. Here, you need $100,000, right? You're going to need $100,000 to do this deal over here, right? That's just what it's going to come down to, $95,000 to $100,000. So what would you rather do, right? What would you rather do? Pay $15,000, right, at let's say a 10% interest, right, but not have any monthly payments at all, be out $6,700 over 6 months. Not bad, right? And when you have $6,700 out of pocket, right, and let's assume that you made even just $30,000 profit on this deal. Let's not call it 50. Let's just say you made $30,000, right? And you made that in 6 months, right? So you invested $6,700, right? If we divide that into 30,000, right? You made a 22.3% rate of return in 6 months. So annualized, right? If you did that twice, you made 60 grand and it was the same type of deal, you did that twice, you made a 44.6% rate of return, right? So why would you borrow or be worried about paying a little bit more interest, right? If you're making a 40+% ROI, right? It doesn't really matter. Over here though, think about it. Let's say you make the same profit, $30,000, okay? You guys need to understand this if you're gonna be in business, right? It's cash on cash rate of return. If I'm into this deal for 100 grand, right? With all the money that I have to put up, the 85 and all the monthly payments for that 6 months, I'm into it for $100,000 and I make $30,000, right? So $30,000 divided by $100,000, right? Times 100, right? Is a 30%. Well, wait a second, I'm doing this wrong. Because $6,700 divided by $30,000. I did that wrong. $30,000 divided by 6,700. Why am I doing this wrong? Okay, sorry about that. I was drawing a blank. I did it wrong. This is not right. So let's go back to this for a second. So you invest 6,700 bucks, and sorry for this, but you invest 6,700 bucks and you make a $30,000 profit, right? So just simple math. I'm a little bit of an idiot right now, but it's late. It's 11:30 at night. So if you invested 6,700 bucks, right, and you got your money back plus you got another 6,700 bucks, that would be 100% return on investment. We're not making only 6,700. We're making a lot more than that. We're making 30 grand. So you take $30,000, right? I did it the opposite way because I wasn't thinking, right? Times 100 to make it a percentage. We made a 447.7% rate of return on our money. But that was in 6 months. So annualized, we multiply it times 2, and we made almost a 900%. 900%, right? Meaning, imagine if you invested in a stock and you put 6,700 in and you got $30,000 back. And then you did it again. So you put $6,700 in all year and you got 60 grand back, right? That makes sense, right? Look at that 900% rate of return. Talk about 10xing your money, right? Because if you invested this all year and you made 60 grand, that's almost 10x in it. If you made 67,000, it would be 1,000% return on investment. So over here, let's look at the percentage again, right? You invest $100,000 and you get $30,000 in profit, right? You get your money back plus you make 30 grand, you make a 30% ROI, right? And if you do that annually, it's 60%. Is it great? Heck yeah, right? Is that a great place to put your money? Yes, it's a great place to put your money. It's not the only place to put your money, right? Because over here, you might be able to do 3 properties, right? Or 4 properties or 5 properties instead of going the traditional banking route and doing 100 grand. Is this making sense to you? As I look at the screen, that's kind of funny. It might not be making sense, especially if you're tuning in right now, right? So anyway, so that's private money lender versus a bank. Then you have a hard money lender. A hard money lender is basically an easy private money lender. You have the private money lender and then you have the hard money lenders. Now, one difference that I've noticed about this is here you can definitely negotiate no monthly payments, right? That's something that we want to do, okay? And you can get 100% financing. Now, if you try to get 100% financing over here, it's going to cost you, right? Probably 20 to 22% or so annualized, right? Which, look, they're putting up all the money, right? They're taking all the risk essentially here. Now, if you can put 90% down, right? For example, with Alpha Funding, right? You could put 10% down, get 90% from them. And this is of the total amount, right? So out of the 300,000, you only have to put $30,000 down. And then you're going to have to make some monthly payments, right? So you're going to have interest only monthly payments and then your taxes and insurance, etc., right? Let's say you can get a loan from them for 10% and 2 points, right? And over here, you're borrowing money at 10%. The difference is the 2 points, and then there's going to be some fees, right? So there's going to be about $1,500 or so in fees, right? Why? Because you have to pay for appraisal and a couple other things, the attorney, whatever. So about $1,500, maybe a few $100 more, depending on the type of property it is, right? So you're paying essentially 2 more points and then monthly payments. The good thing is you don't have to look for private money lenders. So then there's the time factor, right? I don't know how to do a clock here, but that's my clock. So you're saving time by this saves you time. Saves time, right? And time is, valuable to us, right? It's very valuable to somebody that I can spend time looking for private money lenders, or I can spend time looking for deals, right? So let's say I didn't have to spend time looking for private money lenders because I was using a hard money lender. And he's going to charge me a couple more points and some additional fees that I wouldn't have to pay over here, right? So 2 points on, 270,000, for example, right? 2 points on 270,000 because they're going to lend me not 300 but 270 is, let's see, 270,000 times 0.02 is 5,400 plus, let's say, 1,500. So we're looking at close to $7,000, right? So it's $7,000 more. Okay, but that's $7,000. You have to ask yourself, well, how much time is it going to take for me to find these private money lenders, pitch to them, right? Present them my opportunities. And then the whole time I need to communicate with them throughout that whole transaction. So for some people, it's more valuable to just have a source of money where they could just go and instead of spending the time here, they spend the time looking for more deals. And if you get one more deal, right, because you're saving the time and you're spending a little bit more money, it's not a bad idea. I'm not saying do one or the other. I'm just showing you guys all the options that you have as a real estate investor. Now, the monthly payments are also a chokehold over here, right? So that's a big thing here, right? If you can try to negotiate where there's, no monthly payments, or the monthly payments are deferred, or you can have interest reserves for that, and then maybe you can get a second loan, right? You might be able to borrow this $30,000, but you're not allowed to put it as a second lien on the property. You would have to just personally guarantee it and do like a promissory note, and you might have to pay a private money lender 10 or 12% for that second lien. Then maybe you could do it that way. You could borrow the mortgage payments. There's always a way to make the deal work if you are resourceful, right? Tony Robbins says it's not about how much money you have, how much time you have. It's about how resourceful you are, right? If you want it bad enough, you'll figure it out, right? And if the deal is good enough, you can raise the money for it. There's a little bit more paperwork here, credit score, things like that, but the requirements are fairly simple. Over here, it's not about your credit. Over here, it's about the house, right? It's about the house. It's about your business plan around that house, the project, and that's what I'm going to talk about on Wednesday on how to present, these opportunities. There's a million other things that I could go into here. I could talk about private money for literally 3 days. In fact, I was the first one that actually did the Fortune Builders Raising Private Money event. I told them that there was a need with the students and said, let's put on an event dedicated and committed to showing people how to raise private money. And I developed the program and the training for that. And there's a lot to it. There's a lot to learn. The good thing is, if you do the private money, it's a gift that keeps on giving, right? Because, for example, I have private money lenders that have lent me money 10, 20, 30 times, and they consider me kind of like their retirement plan, right? And if you're watching this and you're like, wait, I would love to make 10% interest with, somebody that's been doing this and has experience. The way that I do it is I start people off typically at 8%, and then on the next one I give them 8.25, and then on the next one I give them 8.5, etc., and it goes up. And they get an incentive and make more money the more loyal they are and the more transactions they do with me. There's not a lot of options to make a great rate of return for a short-term investment collateralized by a tangible piece of real estate, right? If I'm buying a house for 200,000 and I'm buying a house for 200,000 and I'm putting $100,000 in renovations into it, right? And this is the money that somebody's lending me, or it's two people. It could be one person here and another person here. And then I'm going to sell it for 400,000, right? I basically need to make $100,000 in mistakes, right, for somebody to lose money, right? And obviously there's closing costs and there's, things like that. Obviously I'm going to be putting up all the property taxes, insurance, maintenance, utilities, all that stuff. But it's a good opportunity for somebody. If you have $100,000, right, and you're making 8% on that money, this thing keeps clicking, 8% on that money, that's $8,000 in passive income that you're making, right, per year, right? If you have 200,000, right, that's $16,000 a year, etc., right? And then you can go making more, right? There's some investors that'll give you 10% or 12%, right? It depends on the deal and the transaction. And I also did a whole training on what you should ask and what you should look for if you are interested in being a private money lender, right? Because you don't want to be in a position where you're lending money to somebody and, they don't have a good track record, or, maybe somebody's new and that's fine, but there's some things that can, hurt them big time, and you need to know what those things are just to protect yourself in the case that things go wrong. There's quite a bit. I'll do another video on that. I did a whole training at that on NJRSN. So if you're interested in this stuff, I recommend that you come out to this event, njresn.com. Put a www in front of it, or else it doesn't work for some reason. We're trying to figure that out. Put www.njresn.com and come out to our next event. It is going to be amazing. I'm going to break down how to approach private money lenders, exactly what you should say to private money lenders, the documents that you should be using with private money lenders, your business model, how to present your business model, how to practice your business model as a real estate investor, and just all the benefits, right, of really borrowing money. I also have Dave Hansel from Alpha Funding. They've been a great partner of ours. They're one of our vendors at NJRSN for many, many years, and they've lent a ton of people money. I think they do $100 million in loans per year. So there's a lot of people doing this. And one thing that you should really take into consideration, because some people are against like borrowing money or getting into debt, right? There's good debt and there's bad debt, in my opinion. And, if you have all the cash and you want to invest your own money in this, that's great. Do it with your own money, right? Just protect yourself and make sure that you know what you're doing so you don't lose all that hard-earned money that you've worked so hard for, right? If you want to lend money, right, you got to make sure that you're doing it with the right people and that you're doing it on the right type of property, right? So it might be tough for you to underwrite that deal. So you have to have an investor that's going to show you what the numbers are and provide supporting evidence that those are accurate numbers, right? But just understand that there's companies like Alpha Funding out there that will, with 10% down, sometimes less, will lend you the majority, 90% of the money for you to flip a house, for you to buy a house, fix it up, and sell it. And that's really, really different than saving up $300,000 before you can do a flip, right? And I know a lot of people are into flipping, and it's very dangerous if you don't know what you're doing. So you want to make sure that you get educated. And one way to do that is to come out to our events. We have an amazing community, an amazing network of people. I've been doing this since 2006. I flipped my first house in 2007, started buying multifamilies in 2009. I'm doing commercial real estate. I buy, fix, and sell single family homes, multifamily homes, and then I also buy and hold properties. I'm converting a property right now in Ridgewood that I purchased right across the street from the train station. I'm putting a restaurant bar on the first floor. We just got our liquor license approved for transfer, and we're just waiting on a couple things for that. And then we're going to put a hotel not a hotel, but overnight accommodations as for an inn. So it's kind of like a boutique hotel on the second floor. So we're actually converting this building that was office space on the second floor to overnight accommodations, where we can rent it on Airbnb and rent it as a hotel. And on the first floor, we have a hair salon, a tailor shop, and then we're going to put a bar restaurant in one of our 1,000 square foot spaces there. And that's going to like double the value of the building, right? And there's going to be a big investment that we make to build that out and make it the way it needs to be. But that's one of our legacy properties. This is about building wealth and building passive income, not just flipping, right? Having the skills to be able to borrow other people's money to, fix up a property and either refinance it, right? Because you can use private money loans to buy a multifamily, right? That's in major disrepair, but you got it in order for you to get it for a good deal, you have to buy it cash and you have to buy it quickly, right? They don't want to wait 30, 45 days for you to go through getting a mortgage, right? They want you to have speed and get in and get them their money, and they could go and do what they have to do, pay bills, whatever it is that that's happening in their life. And there's a lot of people like that. It's just like when you trade in your car, right? You trade in your car at a discount, and you trade it at a discount because of the convenience. So that's what we do. We buy people's properties, land, buildings, whatever, at a discount in exchange for quickness, in exchange for limited inspections, in exchange for really good terms. It's not rocket science what we do. It does require skills, and if you want to be mentored, you want to be coached, you want to be trained, there's many different ways to do that. One of the best ways to do that is come out to my club that I've been, coaching and training people for many, many years, and I love it. I enjoy being a piece of people's puzzle to build legacy, to build wealth. I also run a real estate brokerage, Signature Realty NJ, and we have over 100 real estate agents at our office. My wife is, one of the best realtors in the state, and we have a lot of experience in this stuff. And if you're a realtor and you're watching this and you're learning a lot and you're interested in also learning about investing, you might want to consider interviewing with us. So go to signaturerealtynj.com and click on the careers page and apply there, and we'll set up an interview, right? And if that's something that you're interested in, we have a brand new commission program we just came out with, and it's super aggressive. I think it's the best commission plan in the state. I haven't announced it yet, but if you're interested and you're a realtor and you're also an investor and you want to learn about investing as well, we do a ton of trainings, and that's what this is all about. It's about, just being surrounded by people that have the same goals as you. And, why not put yourself in a position to win, right? If you want to be a champion in a basketball team or, a football team, you want to join a team that has really experienced players and they're really good at what they do. And that's what NJRASN is all about, and that's what Signature Realty is all about. So guys, again, if you want to come out to the event, there's a $15 discount code. It's only $35 to come, but it ends up being like $20 if you use it. If you go to this website, njrasn.com, and then above the link you put fblive.com. I'll actually just show you real quick. I guess I can't. So just put in the promo code, and if you don't know where the promo code is, it's when you go to checkout. Well, not when you go to checkout. When you click on tickets, there's a little link that says enter promo code. So look for that on the page. It's kind of small. I wish it was bigger. It's hard to see, and it's like a little light blue. So click on that and then enter FB Live, and it'll subtract $15. We're only doing that for the first 20 people that do this. So go there and do it now, or hopefully you already did it in the beginning of the video. Thanks, guys, checking out. It's Jon Steingraber. Anything you guys need, reach out to us. We're here. That's what it's all about, helping each other grow. Our motto at NJRSN is seek to serve.